Welcome to the Lang Trailers podcast. This is a mini series on how to start and grow a restroom trailer rental company. This will be good for anybody that's possibly thinking about getting into the restroom trailer rental business, or people that are already in the business and looking to maybe expand their business a little bit and grow their fleet of trailers and maybe their footprint. Today, we're going to be discussing equipment financing and how it plays a role in the restroom trailer industry. I have with me today Ethan Keeler from Sage Creek Capital. He does a lot of loans for our customers, particularly startup customers. So we thought we'd bring him in and let him share his expertise on what equipment financing is and how it can help you as a new restroom trailer rental business. So with no further ado, I will let Ethan introduce himself and go over a little bit about what equipment financing is.
Thanks, Steve. So I work at Sage Creek Capital. My background has been in corporate lending. So I spent over a decade in corporate lending with large multi-million-dollar businesses. We've kind of scaled that back now. We're at Sage Creek, and we really have a mixture of everything. So we focus on the particular industry. And at Sage Creek, we want to be more than just a lender. We want to focus on particular industries. And when we're in those industries, we want to help to bring in expertise. So we've developed an entire portfolio around the restroom trailer business so we can help our clients, like you said, focus on the startups and what are the priorities and how to grow that and scale that business into one or two or 10 or 20 or 100, you name it. But we want to be a resource for the customers as they continue to scale the business.
So, I know I get a lot of phone calls from people looking to get into this business. And financing can definitely be a big hurdle, especially for people that have not been in business for 2 years. How do you help those people, along with the people that are already in the business?
Sure. Yeah. So it's a great question. And I think the important part is to recognize where you are and where you want to go. And so companies that haven't started, I've got customers call me that don't even have a legal name yet. We can still help them get started. But it's all about what lenders are looking for. And so I always tell my customers the ultimate goal is in 3 to 5 years, you should have banks calling you, should have options for financing. And if you're doing things right, you will. So when it comes to startup companies, it's possible. It's all about you as the individual and making sure that you're setting the track record straight on where you want to get to. There's a big difference between banks and equipment finance companies. And I think it's important to highlight what those are. When you look at banks have deposits from individuals, from companies, and they're lending out those deposits. So they're not allowed to lend to speculative investments. So because of that, a startup restroom trailer business is considered a speculative investment. So you're not going to find yourself getting funds from a bank in the first 2 years of business. So you'll have to lean towards an equipment finance company. Equipment finance companies operate a bit differently, but they're able to take on a bit more risky investments that banks don't. So it really just depends where you are in the life of your business. But there are options, even if you haven't been in business for that standard 2 years, which is what banks typically look for.
So is there a reason you'd go with equipment financing versus a bank, as far as because I do have a lot of customers that will get a personal loan, get a home equity loan, and use that to buy their first trailer. Is that a good way to go about this, or is there a reason they shouldn't be doing that?
I wouldn't say it's the wrong way, but it's the question I always ask is, do you want to buy one trailer or do you want to buy multiple or have the ability to buy multiple? And so if you're looking at being able to have this and scale this into a business, borrowing against a home equity line or drawing against a 401k, there's repercussions from that. So you want to be careful doing that. The best option is to make sure your first loan is structured properly. And I can't stress the importance of that for a startup. A lot of times what we'll see is they'll borrow against the 401k. And then in 6 to 12 months, they want to come back and buy another one. But when you're borrowing against that or taking on personal debt, all you're doing is dinging your FICO score. And so if you are a startup company, that's all that lenders have to look at is that FICO score. So you're actually doing more harm to yourself in the long term if you plan to scale this business. So I don't encourage that for the first one, although it's an option and I wouldn't say it's the wrong one. It's not the most optimized one if you're having the ability to scale this.
What are you looking for to qualify someone, especially a startup. I know most lenders, even EFAs that we work with, they're looking at that PayNet score. Obviously, somebody that hasn't been in business for 2 years doesn't have that PayNet score. So, where are the startups or people that have been in business for less than 2 years? What are you using to qualify them?
Sure. Good question. So a lot of it is the individual, right? A lot of the companies don't even exist when we start the conversation. So your FICO score is going to play a big factor. And what people don't realize is that FICO score is not the moment you apply for the loan, right? So anything you can do leading up to that is really helpful. So paying down credit card debt, making sure you don't miss payments. But what a lot of people don't realize is that just because you make a big payment on a credit card the minute before you apply for the loan doesn't mean your FICO score is going to automatically jump. It takes a couple of months for those payments to fully be reflected. So anything you can be doing along the way as you start the process, paying things down, making sure you're paying on time. Bankruptcies obviously are going to be a big hit to you, but those things, the sooner you can start that, the better your odds are on getting a favorable structure.
So this is something that people should be working on ahead of time, not just when they're ready to get a loan. Should be a full-time job to do this.
Absolutely. And speaking of structure, that's what we talk about the most. Is it's going to be the most important thing for you is making sure that your structure is one that's going to help build the foundation. So there's a few key elements to what you should be requiring from your lender. The first one is making sure that the loan is to the newly established business. I think people often assume that if they get a loan, they're helping build credit. If you get the loan to you personally, you're not going to be establishing that business credit. Oftentimes what people will do is the bank will work with them. The bank will kind of twist what they originally want. They'll want the loan to the new business. And by the time they're done talking to the bank shows them the lower interest rate, but requires it go to the individual. So if you do that, it's a way to get the funds, but you're not building that track record. And ultimately, when you go to buy the second or third unit, you're in the same position you were in 6 or 12 months beforehand. So make sure the loan's to the business itself. Another part of it is make sure that the lender's reporting back to the credit agencies. A lot of people don't realize, but lenders, more often than not, will just report back when you miss a payment. So they're happy to ding your credit, but they won't give you credit for making payments on time. So it's really important to make sure your lender's doing that and on a regular basis. Another one, like we talked about, is borrowing against 401k or doing something personally that impacts your FICO score. For those first 2 years, you don't have a PayNet. So your FICO score is going to be what's driving that yes or no ultimately. So you make sure that you are properly getting the funds. And the other part is a healthy down payment helps to keep the monthly payments down. But what you don't want to do is use all of your capital right away. There's going to be rainy days. People that are new to business don't understand exactly how a business operates. And so there's nothing wrong with that. But you want to make sure that you've got some cushion for yourself in the event that you don't have a rental 1 week, that you're not living week to week. And so the proper structure is going to be crucial for success for the life of the business. And that's what we focus on, is building that foundation, especially with that first loan.
So, bank loans, I know to me, it's always a tedious process. Going through the whole process and actually applying for a loan is often enough to stop me from wanting to do that. Can you go through a little bit about what that process looks like and how difficult it is for the in the EFA world?
Yeah, that's why I'm not in banking anymore. It was overly complicated at banks, and rightfully so. They're highly regulated. So with a bank, right, the traditional loan is going to be requiring all of the paperwork, your tax returns. What happens with a bank loan, though, is more often than not, they're going to tie the business up. They're going to have a pledge of all business assets. They're going to require some type of covenants or some type of annual reporting with tax returns or personal financial statements or company prepared financials. There's nothing wrong with that. But the reality is, until you're a larger business, there really shouldn't be a need for that. So with the EFAs, they're a very simple document. They're intended to be user friendly on both ends. And the reason is you need to be running your business, right? So with an EFA, it's a very simple structure what it is a pledge of the asset, right? So for the restroom trailers, the lender will take the title. The application process itself, with Sage Creek, I can really only speak to Sage Creek's specific applications. We've got three parts to it. It's who is the company, who are you, what are you buying? And so that's part of it. And then our team will follow up and have the conversation to understand the why and understand your knowledge of the industry, your experience in owning a business. And even I encourage people to even start with the application process. It helps to understand where you're headed and what you need. And it's a soft credit pull for us, so it doesn't ding your credit. You don't even have to have the name of the business to get started, right? It'll be a requirement going forward, but it's a very simple process. So once you get that in, our team will call, we'll talk through it. What you'll typically be required is providing a couple of bank statements, your legal ownership of the company, once you have that. And then we have the documents. The documents are intended to be very cut and dry. It's no annual reporting, right? Like I said, we're taking the asset until you pay us off, and then you get it back. But from the process from start to finish, and we've done this with Lang, we've gotten an application in and we've funded Lang the same day. It really just depends how fast the applicant wants to move with the process. But because it is very simple, it doesn't take long. The other big difference with the EFAs and the traditional bank loans have that separation of principal and interest, and banks are always taunting the lower interest rates. Because EFAs or equipment finance agreements are so simple, it's set up to just be a monthly payment. So it shows as a payable every month. It's set up for auto debit. At the end of each month, you make the payment. The process is designed to be very simple so that we don't overcomplicate something that doesn't need to overcomplicate it.
Is there anything else that you think that is important for people to know about the equipment finance world, or just finance in general, as it relates to getting started in this business?
Like I said, the important part is building that foundation, understanding what the loan is going to look like, and understanding where you want to go. And what I've done for my career, whether it be in Sage Creek or my prior corporate lending role, you focus on where you are today and where you want to go. And that's where no loan is always going to be the same. You're going to want to make sure that you understand where you're trying to get to and have a partner in your lender that's going to help you get there. And that's why I can't stress enough that first loan being such a critical loan to build the foundation, so that the other ones are simple, right? You can always pay cash for the next couple, but if you build the foundation with that first one, it's going to help you be successful throughout your career, or however far you take the business.
Well, Ethan, do you want to let everybody know how to get a hold of you, or how to put an application? I understand the application is no obligation, so people were able to put this application in and essentially get a quote from you on what it would look like, and there's no penalty if they decide not to move forward.
Yeah, it's worth a conversation. And like I said, even if you're thinking about it, you don't necessarily have a legal name established, it's worth putting in the application. We'll have one of our team members get in touch with you. The easiest way is if you're on Lang's website, which you obviously are if you're listening to the podcast. Up in the top, there's a apply for financing link. It'll take you right to the Sage Creek Capital application. That application will go through the process, like I said. It's been a lot of fun working with Lang so far. I never thought I'd see the success rates of the companies that are starting out. And I think that's why a lot of banks don't necessarily like startups. And not only that, but they look at the collateral of a restroom trailer and don't understand it. Yeah. What we've developed at Sage Creek in our portfolio, it's a niche. We understand it. We understand the market. We understand the resale for it. And we understand that it's not that difficult to be successful. I think based on the numbers that we have, the national averages, it's about 7 rentals a year for a startup company. 7 rentals a year will pay the debt service on the loan that you have. So for me, when you boil things down to numbers, that's pretty impactful to being successful and starting to pull the trigger on something that you might be contemplating.
Yeah. So theoretically, in under 2 months, you should have taken enough rentals in to pay for the whole year. The other 10 months you're making money on that trailer.
Yeah. And we've worked with you and your customers. We've got a bit of a business model that shows that. I'm the numbers guy, so I need to see it in the numbers. But with the application, once we get the application, what we typically do is we'll follow up with the customer. We'll show you what it would look like based on what you're purchasing, what the cost of that is, and what the credit profile of the individual in the business looks like. We'll show you what the monthly payment is and what the costs are associated with running that business. And the returns, I didn't believe it at first when you guys sent me the numbers, but we're seeing it with our customers, and it's worth looking into as a side investment or a startup company.
Well, everybody, thanks for watching today. Once again, this was the Lang Trailers podcast. If you have any questions about restroom trailers, please reach out to Lang at 724-972-6590, or you can find us at our website, langrestroomtrailers.com. Once again, Ethan, I want to thank you. Ethan with Sage Creek Capital, I want to thank you for being here today. You really put some valuable information out here for the listeners. So thank you.
Thanks for having me.